Building an investment portfolio that pays you large sums of money is something that anyone can do. My portfolio recently crossed the $20,000 mark with market-beating returns, and I'm going to share my full guide and specific steps of how to build a portfolio of high-quality businesses that can grow with you over time. Each one of these steps has subpoints that I'll go over in that section of the video. I started my portfolio last year in March with $4,000 from selling my car from college. From there, I've slowly but consistently added any extra money I had to my portfolio into high quality companies that have started to pay me over time. The end goal of investing for me is to make working an option, not a necessity. I'll go over my holdings throughout the video as well and why I think they are positioned to help me get to the point of financial freedom. The video is timestamped for those who are at different steps in the process, so you can skip around depending on where you're at. Subscribe and like the video if you enjoy transparent videos about investing and growing and protecting your wealth. Here you can see that since I opened my account with M1, I've been depositing as much money as I can. My initial deposit was from the money I got from selling my car at college like I previously mentioned, but the rest is just from working. These small deposits start to add up over time, and the reason it's important to start building capital is so that your money can start to compound. The most important metric to figure out in order to do this is the gap between your monthly income and your expenses. This is the number that you have to add to your investment account or to spend on other discretionary things. The more you're able to add, the faster you'll be able to start the process of compound interest. If we look at the equation for compound interest itself, the three components are the principal amount. This is just how much you put into an investment, time, and the rate at which the money is compounding for each additional unit of time. This is the annual return we're seeking. In order to get on the path of building a large investment portfolio, it's really important to try to increase the principal amount in your portfolio at the beginning. This is because when you don't have any money invested, you don't have any money working for you, and you'll always have to trade time for more money. But as you start to build your portfolio, the money can start working for you, so you'll be able to free up more and more time to do other things. To do this, I recommend building a monthly budget in order to get a feel for how much you have left over after all the expenses are paid for each month. And when you've at the very least gone through a budgeting exercise, even if it's not extremely detailed, it can give you an idea for how much you'll be able to add to your portfolio every month. This can be done on pen and paper or on an Excel spreadsheet, but it really doesn't take too long. This is a really important first step to start building capital that you can invest in the market. The next step is maybe the most important. It's about understanding how to have a long-term time horizon with your investments. This is one of the components of compound interest. The more that you can increase the time part of the equation, the more you'll be able to return. In order to keep the competitive advantage we have as individual investors over the people on Wall Street, it's important that you do this. We don't face any pressures like they do to perform and make trades on a yearly basis or have to deal with withdrawals from people that have invested in their firms, when a lot of the time it's more prudent to just do nothing with your investments. The money is made in the holding, and when you invest in a company and become an owner, you have to let the business do the work for you. There are many different reasons why large flows of cash can go into or out of the stock market from these funds, and we don't have to pay attention to these. They can swing the stock prices in the short term wildly, which allows us as individual investors to take advantage of these swings in prices that don't actually reflect the fundamentals of the business. If we look at my portfolio, this was the case for my Google investment that I made last year. I started this investment around March, and I continued to buy throughout the year as I thought the stock price was undervalued, but more on that later. This is my longest held position, and the thesis I had on this company has started to play out over the last year. The other two positions I have are Netflix and Mastercard, which I'm now building out with new funds that I add to my brokerage account. And so I'll wait to see how these play out over the long term. So I'm not really concerned with short-term price fluctuations. Over time, the intrinsic values of these businesses should be realized, and the prices of these companies should revert closer or even above the actual value of the business. This is how companies pay us as shareholders, through capital gains, which is the stock price going up, like we've seen with Google, but also through dividends. This is when a company pays you a percentage of free cash flow as an owner of the business. M1 tracks dividends, so you can see what I've been paid and will be paid in the future. The total value of my portfolio is still not very high yet, and so the companies I've invested in aren't paying me large dividends yet, so these numbers are still low. But over time, as the dividend yield, or percentage of the profits per share that are paid to me as an owner grows, as well as the stock price, the number will grow at a faster and faster rate. This is how you start to get compound interest rolling. Lastly is share buybacks, which reduces the amount of overall shares in the market, which in turn increases your slice of ownership of the business. The money that you put into the stock market should be money that you don't need to use for the foreseeable future to allow this process to happen. Becoming an owner of a business only pays profits once the business can work for you, which is why having the long-term mindset is so important. The money is made in the holding of high-quality companies that will compound their earnings for the next 5 to 10 years. Once you get to the step of trying to find the right businesses to invest in, the first thing you should be trying to figure out is how the business actually makes money and how sustainably they can protect and grow that money into the future. This is the initial research work that can be done as slowly as you need, and we'll go over how to do this. I like looking for companies and industries that I'm comfortable with because they're generally easier for me to understand. A lot of times I'm a consumer of one of their products, or if I'm not, I've consumed something similar to theirs. This is part of the advantage you have as an investor. I believe that anyone can do this. Putting in an hour or so a week to start to understand how companies work will pay substantial dividends later in life. If a business can protect and grow their cash flows for years to come, it has a much higher probability of compounding over time. In general, these companies have high barriers to entry in their niche or industry. This is what we call an economic moat. And there are many different types of moats that businesses have, and a lot of them are unique in their own way. It sounds simple, but truly understanding the inner workings of a company's operations and how they get their competitive advantage can in turn make you feel more comfortable about the risk factors they face. This can take some time, but the more time you put into researching a company, the more comfortable you can get with how they operate, and in turn build up conviction to put an investment into that company. I choose to write my thoughts down in notes as I look at companies to make sure that I'm being consistent with my thinking and analyzing the risk factors fairly. Looking at an example of this, I have a short note that's actually dated from last summer, which is when I was looking into Google. This is about their compute advantage and how I think it contributed to their economic moat. This note talks about Google's vertical integration and their cost structure. I think this contributes to the larger moat for the company. This vertical integration means that they own all aspects of production that they need for their products, allowing them to control pricing. Google's ability to operate at all levels of the tech stack means they can operate with more efficiency. In order to find out if a company has a moat, you look into their financial statements, listen to quarterly earnings calls from management, and find any resources or data points about the company or the business environment they operate in. AI is also a great tool for researching and analyzing stocks. Here's Mike Green, who's a chief strategist and portfolio manager for Simplify Asset Management. He's a leader in market theory and how passive flows affect stock prices. And here he talks about how he uses AI in his investment process.
Spend a lot of time building models and exploring theoretical frameworks. And LLMs are an extraordinary tool in that context. I use them nonstop, right? I use them nonstop. I have, multiple pro level subscriptions to Claude, ChatGPT, Gemini, Grok. I just expanded my usage of. For the very simple reason that I view them effectively as first year and increasingly second year analysts. I would probably say that Gemini has now become a second year analyst and is probably my favorite. From an analysis standpoint, Gemini is really, really good.
So you want to find high quality businesses that are protected from the engine of capitalism, which is competition, through their economic moat. That's not to say that you can't sell out of a company if the fundamentals or facts changed, but in general, you want to let these companies do the work. Ideally, your initial thesis proves right, and you can see this play out over the next 1 to 3 years. This is the case for my Mastercard position. I'm still in that waiting phase where I'm waiting for what I believe the stock price to revert a little bit closer to the PE ratio that it used to trade at. I started this position on November 19th of last year, with the plan to continue building out this position with any short-term uncertainty regarding the stock price. There are many different ways to value a business, and different companies can require different forms of valuation. However, for the most part, you're trying to figure out how much cash you can pull out of the business moving forward. Just because you found a great company like Mastercard doesn't mean it's a great investment. The price you pay matter. If the market has already factored in the growth of a business into the stock price, there is a lot less upside and increased downside. In the case of Mastercard, I still think the company is growing fast, and I think that the stock price is relatively low based on where I think the future growth rates will be. The only way to consistently protect your money from permanent capital loss in any market condition is to buy these great businesses when they are not overpriced but reasonably or cheaply priced, depending on the financial standing of the business and their earnings power moving forward. The reason you invest at all is to receive more money back in the future on the money you're outlaying in the present. Because of this, to value a business, you have to estimate the future cash flows of the business and then subtract a percentage of those cash flows because of the time value of money. This is called the discount rate. This is the required return for owning any asset, because a dollar today is worth more than a dollar at any point in the future due to the earnings potential of having money in the present, as well as inflation and risk factors that takes place over time when you're invested in markets. You can again find these on the financial statements, as well as tons of free websites and softwares that have this data. And then, because of the time value of money, we're going to subtract a percentage of those cash flows. So you're going to project out the future cash flows with a growth rate based on how fast you think the business will grow, and then discount those future cash flows back to the present value. I'm going to continue with the Google example for this step. So this is just an example of a valuation I have from last summer for Google. And as you can see, I had estimated out the cash flows over 10 years, and I don't have all the numbers out. But you can see that I valued the different segments of Alphabet's overall business, and then I summed the total. You also have to account for other assets like cash that provide value as an owner. And at the end of this calculation, you get an intrinsic value per share price. At the time, Google was trading at $178, and so you can see my margin of safety was 23% of what I thought the business was actually worth. And as you can see, over time, the stock price corrected closer to what I thought the business was worth. This is the capital gains I was talking about earlier in the video. But this is generally the main way that money is returned to you as a shareholder, unless you're strictly looking for dividends. I want to just look at another example of a valuation tool. This is fiscal.ai. And as you can see, this is how the revenue is growing over time. And then what they do is they project out into the future and have boxes that you can fill in and change your estimate. After you subtract everything out that will affect free cash flow, you get your unlevered free cash flow numbers. And then applying a discount rate, which in this model is a weighted average cost of capital, it's just another discount rate, which is again going to subtract a percentage out of those free cash flows. You then apply a multiple PE ratio. This is the relative valuation that you think the company will hold over time. I like to look at historical averages for this, and the strength of a company's moat and how fast the business grows often plays a big part in the PE ratio that it trades at. Microsoft is generally above 30, so there's 33 in here. This is not a real valuation, by the way. This is just an example. But you can see at the end you get an implied share price. This is the same thing as the intrinsic value per share. Compared to the stock price today, you can see that there's no margin of safety. This is generally how the valuation process works, and I'll be going into it in more detail in future videos. This is how you get the limited downside and asymmetric upside that we're looking for. The most important part of any discounted cash flow analysis are the assumptions that you put in. Investors love to put in bullish growth rates and high terminal PE multiple just to justify buying a stock that really isn't cheap on an absolute basis. Most recently, I've put money into Mastercard and Netflix with a plan to build out these two positions with any further volatility in the stock price this year. Both companies are undergoing some short-term headwinds, but I believe their economic moats are strong. These are two examples of extremely high-quality companies that I think will return a lot of money to me as an owner over the long term. I'll be going into these companies more in future videos and why I think they're well positioned for this year. But this is when we get to the final step. The last step of building a portfolio is the buying process. In my opinion, whatever money you have to invest should go to the idea that you have the most conviction in. The economic rule of opportunity cost is at play here. You have to look at what the next best alternative is to where you could be putting your money. At the end of the day, we're seeking returns, and wherever you think that will be highest, that's where I believe you should put your money. The end goal for my portfolio is to hold 10 or 15 companies that have strong economic moats that will help grow my portfolio into a cash-generating machine. But getting more into the buying process, I wanted to look at my watch list. These are companies that I'm waiting to go to a lower price to enter into a position. Now, not all of these companies have the type of moat I'm looking for, but I do like to keep tabs on certain businesses and certain sectors just in case there's some broader macroeconomic news that could affect other companies. You want to make sure that you're concentrated enough to beat the market, because in order to outperform, you do have to be different from the crowd. But you don't want to be so concentrated that any bad news or a slight miss on an earnings call can cause your whole portfolio to tank. This is why I'm building out new positions with any funds that I add to my portfolio. The important thing is to have your margin of safety built into your investment so that you're protected from that downside. But I really believe that this lays the foundation for reaching financial freedom. And the more you start to look into businesses, the more comfortable you get with the whole process, and it just gets easier. If you made it to the end of the video, here's a link to my video on Netflix and a little bit about their moat. Subscribe for more content like this in the future.